to this presentation of Whole Farm Revenue Protection, an introduction of an emerging risk management choice. It's presented by the University of Delaware Extension and the USDA Risk Management Agency through an education and outreach partnership. Extension does not sell crop insurance. This video is part of an effort to raise producer awareness of all crop insurance and revenue protection options, and we accomplish that through workshops, newsletters, personal consultation, and presentations like this. After viewing this presentation, you can follow up with any crop insurance question by calling Don Clifton, Risk Management Education Program Specialist, at 302-242-8806, or you can email your questions. We can work on scenarios together before you contact an agent at no cost to you. We may be able to help you ask the right questions when you talk to your agent. Coverage options in Delaware and on Delmarva include the traditional yield protection, revenue protection, and the topic of this presentation, whole farm revenue protection. This is a very quick introduction and overview of whole farm revenue protection, which is available to cover previously insurable and uninsurable crops, livestock, greenhouse, and nursery crops. WFRP can be viewed as an umbrella policy covering a wide array of farm production, insurable and non-insurable. It is especially important for some of the non-insurable crops because they tend to be high revenue, high input ventures involving relatively higher risk. Such crops can often represent a higher proportion of a farm revenue than some of our insurable crops. Producers who should consider WFRP are those who are producing otherwise non-insurable crops, a mix of insurable and non-insurable crops, including livestock, those who are doing some direct marketing, and those who have some greenhouse and or nursery production. In this presentation, we'll introduce the idea that WFRP is constructed around the annual business practices of producers, things we're already practicing, like filing taxes. Every operation files taxes, and the exercise of annual production planning for income and expenses. Every operation does budgeting and income analysis for the coming year. If you're doing these things anyway, working with an agent of your choice, you may qualify for up to 85% revenue protection at an attractive premium price. WFRP can provide up to $8.5 million in total coverage if an operation is producing at least a minimum of 3 commodities. There are some limitations to WFRP. The previously mentioned $8.5 million in revenue, you could have up to $1 million in expected revenue from animals and animal products. You'd have up to $1 million in expected revenue from greenhouse and or nursery. No more than 50% of the revenue can come from commodities purchased for resale. And if potatoes are grown on the farm, the operation must have at least 2 commodities. WFRP is considered a pilot program and is very substantially subsidized by the Risk Management Agency. Even at the higher levels of 75, 80, and 85%, this chart shows that the premium subsidies are quite substantial, which brings the farmer paid premium down to a very reasonable level. Some key concepts are the allowable revenue, allowable expenses, whole farm history report, approved revenue, approved expenses, and the farm operation report. Farm operation report is basically your plan for the coming year and acts as a progress report throughout that growing season. The agent of your choice will provide forms for reporting and calculating these key components of WFRP. Whole farm coverage can be viewed as an overall or umbrella type coverage. You can continue to insure your insurable crops individually, but take a coverage layer over top, which would include other possibly non-insurable enterprises, but also could enhance the coverage of those individually insurable crops. WFRP in the first year of coverage can take a considerable amount of time to calculate and get established with your agent. Agents are knowledgeable professionals, and they work to deliver all kinds of policies to a lot of producers. They need some time to work the forms with you, so you should start well before the sales closing date. Communication is a big key, as it is in almost all aspects of business. You need to start a dialogue with your agent, ask questions, but also expect answers to those questions. Respond quickly if they ask for more information. Keep them apprised of progress throughout the season, and provide timely notice of loss if and when that happens. First step in determining WFRP coverage is to establish a historical revenue base of information as derived from your income tax forms like Schedule F, or the agent will construct a substitute Schedule F if another form is used for tax filing purposes, such as Form 1120, the U.S. Corporation Income Tax Return. You can actually get credit for a higher average income than you have produced in a simple average. This is called an indexed average revenue, and it reflects positive trends in your farm income. To qualify, you'd have to have 5 years of farm tax forms, and either of the last 2 years must have greater revenue than the 5-year average. You can also get enhanced coverage due to an expanded operation consideration, which requires the insurance provider approval. This slide shows an example, fictitious example, of a possible whole farm history report for coverage in the year 2019. For 2019, the 5 years of 2013 through 2017 are used to develop the average revenue. 2018 is not considered and is considered the lag year. In this calculation, we see that the simple average of the 5 years is $138,392. However, since 2017 was trending higher, the producer gets credit for that, and there is an indexed average of $184,200. An expanded operation consideration is made. The historic average is considered the greater of the prior 3 items of the simple average, indexed average, or expanded operation average. And in this case, that is the indexed average of $184,200. The farm operation report establishes the plan for the coming season. You report before, during, and after the season. The intended farm operation report must be provided to the agent before the sales closing date. A revised FOR, which is very similar to an acreage report, is due by July 15th for calendar year tax file. The final FOR is what actually happened and is submitted at the earlier of the time of a loss claim or the sales closing date of the following year, which is the renewal date. This is an example of a farm operation report for intended coverage in 2019. In this example, the producer intends 30 acres of fresh market sweet corn, 7 acres of fresh market tomatoes, 7 acres of watermelons, and 30 acres of mixed hay. The allowable expenses are calculated, as well as the allowable revenue. The allowable expenses come into play if and when there is a loss claim, but the allowable revenue is used to help us establish the coverage levels. In this example, the allowable revenue total is $196,000. The approved revenue is the lesser of the whole farm historic average or the farm operation intended plan. The indexed historic average was $184,200, and the plan indicates expected revenue of $196,000. So the approved revenue is the $184,200. Interestingly, that is greater than any year's prior revenue in the 5-year base period. The highest year in that period was $160,000. This is one aspect that makes whole farm revenue coverage very attractive. The premium for this amount of coverage is reflected on this chart at the higher levels of coverage between 70% and 85%. You can see that due to the previously shown high levels of subsidy, the farmer paid premium is relatively low, from 1.2% of the coverage at the 70% level up to 3.65% at the 85% level. This is a very strong incentive to take whole farm revenue protection at very high levels of coverage, which of course gives you greater protection in the event of a loss. The premium rates for whole farm coverage are attractive compared to individually insured crop premiums under the MPCI policies that we tend to be more familiar with. You can see here that at the 70% level, MPCI rate may be 3%, whereas the WFRP rate is 1.2. At the 85% level, and PCI may be almost 7% of the coverage. WFRP, 3.65. This reflects once again the fact that WFRP is in pilot status and the subsidies for the premiums are very high. So to recap, where does WFRP make sense? Where the operation has otherwise uninsurable crops or commodities such as livestock or greenhouse or nursery, where organic production is protected at realistic prices, where production is direct marketed, where you can provide an umbrella coverage over the other selected individual crop coverages. WFRP also provides a bottom line for the entire operation in case of severe economic loss, and it also makes sense when other plans cost too much. You can look at the WFRP policy on the web. This link shows where the WFRP handbook can be accessed. RMA also has a PowerPoint introduction for WFRP on their website at this link. We either practice risk management or we will inevitably practice crisis management. Get the facts and ask questions before you talk to your agent at decrophelp@gmail.com or call 302-242-8806.